Hello everyone, welcome to Afsara 24/7. My name is Niharika Wale Bhatnagar and I am with you with the area of AFM, Accounting and Financial Management for Bankers. Everybody, the registration date is ending soon for the JAIIB exam May 2024. So please go ahead and register yourself as early as possible. Secondly, our courses are available at 81% discount. So kindly go ahead and check it out right away. Okay, at the same time, please share the session, like it, and if you haven't subscribed to our channel, then hurry up and subscribe it as well. Acha everyone, I'll be meeting you on Sunday for our mini marathon as well. So please be there in the mini marathon. So let's begin everyone. Here comes the first question for the day. Okay. Which of one of the following equates the PV of cash outflows and the present value of the cash inflows of a project? We're looking at the present value of the cash inflows as well as outflows of a specific project, everyone. It is net present value or internal rate of return or payback period or accounting rate of return. What's going to be the answer? Everyone? See, when we talk about the PV of net inflows and outflows, na, when we are taking and it is equating matlab it's absolutely equal. You are having no profit, no loss situation in terms of your present value. This situation actually arises in the case of IRR. The answer to this question is internal rate of return. The answer is IRR. Done. Okay, so let's continue further, everyone. Which of the following statements are true? In terms of estimated cost and standard costs. Acha, standard cost and there are two kinds of cost, huh? Standard cost and the second part is our actual, है ना? We normally compare these two in order to find out whether we are going good in our books of accounts or we are going bad. Standard cost is basically the scientific analysis of engineering studies as well as while estimated costs are historical. Acha, I can say standard is basically when we are setting up a specific area ki this is what we are trying to achieve and this is what one part is what we are trying to achieve and the second part is what we are trying to which we are supposed to get. Estimated is ki acha, if I ask you that how much money you will be spending, like acha, I think I'll be spending roughly this. Standard is what should be your spending amount. When you define your spending amount in this case, that would be considered in this specific area in terms of the standard costing. Okay, what cost will be and the estimate is what should be, and then this is more frequently revised to estimated or estimate costs are more stable. In actual, this is standard costs are based upon scientific. This is the one which should be, and estimated is which could be, right? This is based upon the what happened in the past, and we are trying to find out what will happen in the future. Considering that part, we create our books of accounts. Which of the following statements is not true? An expenditure intended to benefit current year is revenue expenditure. Amount paid for acquiring goodwill is a capital expenditure. Wages paid for installation of a new machine is usually debited to the wages account, or revenue expenditure is not intended to the benefit future period. Which one of the following statement is true? I think if I look at the particular area which is for current year is for revenue expenditure only. This is absolutely correct. Amount paid for acquiring goodwill is a capital expenditure. Goodwill is an intangible asset. Wages paid for installation of a new machinery is usually debited to wages account. Nahi. If you pay any amount for an asset, it will go into that asset. The answer is C. Acha, last one as well. Revenue expenditures are not for future. Revenue means you are spending today to get benefits today itself in the specific year that is covered in this specific area. Done, everyone? Now comes the next question. Which of the following sources of finance has an implicit cost of capital? Preference, debentures, retained earnings, or equity share capital? What do you mean by implicit cost, everyone? Internal costing? When we try to have internal costing, see, preference shares are internal people of the organization, agreed, but do we incur implicit cost in that? And what about the equity? Equity are the owners of the organization. Debentures are care, they are outsiders, so we can say that they are to be kept aside. But the actual answer is retained earnings. This is the savings. They say if you take out your savings for the business, normally it should not have any cost, but it has a cost. So in this case, the answer is retained earnings. The cost of retained earnings is the same as that of cost of equity. ठीक है? Done, everyone? The reason is that if you're using the money that you didn't take out of the business, it's still a part of your business. It has to be here itself in the business only. So it has to be covered that way. If you haven't downloaded the app now, then download the app, because through the app you get all the contents that we are providing in the classes. That means the PDF of the classes are available, the entire scenario of our paid classes, free content, everything is available. Plus, if you download the app right now, you will get 1% additional discount on our courses. Currently it is available at 80%, so you will get 81% discount because of the app. So go ahead and get the app, accumulate the coins and utilize it. For this, you can use the code Y541 to purchase our courses, everyone. If you haven't done it yet, I believe this is the perfect time when you should do it. Acha, a firm has an inventory turnover of 3 and cost of goods sold as 2,70,000. With better inventory management, the inventory turnover is increased to 5. This would result in. Acha, first of all, look at the question. Inventory turnover is 3, which is COGS upon average stock. See, in this case, it is equal to 3 is equal to 2,70,000 divided by average stock. It comes out to be average stock is equal to 2,70,000 divided by 3, which gives me rupees 90,000. This is my current average stock. Now they said the inventory turnover ratio is getting up to 5. है ना? COGS upon average stock is the formula. This means 5 is equal to 2,70,000 divided by average stock. Displacing it, average stock is equal to 2,70,000 divided by 5. That is coming as 54,000. Can you see there's a fall in average stock? The stock that we are having during the year has gone down from 90 to 54. You know? So what's the amount that is coming here? 90 minus 54. That gives us 36. You know? So in this case, the answer is B. Go ahead and check it out, everyone. I hope it is visible clearly, the entire question. Take a moment and see it. Done, everyone? Done with this question altogether? Let's look at the next question now. A very good question. A company proposes to introduce a new product. Now they are introducing new product in the market. They are using PV ratio. PV ratio is quantity divided by sales. When you're using the formula quantity divided by sales, they said your PV is 25%. The variable cost of the product is 300. In actual, sales minus 300 divided by sales is basically what? Is equal to 25%, because quantity is sales minus variable cost. Now multiply. Now this comes out to be 25% of sales is equal to sales minus 300. So sales minus 25% of sales is equal to 300. This gives us 75% of sales is equal to 300. So it comes out to be 300 divided by 75%. The answer comes out to be sales is equal to 300 divided by 75%. It is 400 now. Done, everyone? Easier question? These questions have very small answers, but the questions seems to be tricky, right? Because when we define the PV ratio is quantity upon sales. How do we find contribution? Contribution is sales minus variable cost. Done, everyone? See, the profit volume ratio is sales minus variable cost only. Next question. As per section 52 of the Companies Act 2013, the balance of security premium account cannot be, this is a negative question, cannot be utilized for payment of dividend. It can be writing off discount on issue of shares. It can be Issue of fully paid up shares, it can be. Capital losses, it cannot. So the answer is, acha, uh, capital losses, what kind of losses? ठीक है. This can be right only if they are talking about fictitious losses. Payment of dividend, basically it is allowed to issue bonus and write shares through it. ठीक है. Basically there's another rule of dividend which I missed out. Dividend can be paid only in case you receive it in cash. SPR, once received earlier, cannot be used for the payment of dividend, but it can be used for capital losses. So the correct answer is actually payment of dividend. Next question, which of the following statements are true? Payback period method considers all cash flows of a project, or payback period method concerns more with the recovery of cost than profitability. NPV represents net addition to the wealth of the shareholders, and accounting rate of return method incorporates risk as well as time value of money. A and B, A and D, B and C, and B and D. Payback period is basically in how much time can we recover the specific amount that we are putting in the business. So in this case, can you see when we talk about this entire area, payback is talking about the cash flows of only the period in which we are recovering the payments. So it does not consider entire. So first is definitely not true. So we can keep A out of it. Accounting rate of return method incorporates risk as well as the value of money. Nahi, it does not include. This is a primitive method. So this one is also eliminated. The answer should be C. Okay, that means we are looking at B and C together. When the current ratio is 2:1, if the equal increase in the current assets and the client liabilities would result in no change in current ratio, increase in CR, decrease in CR, or current ratio will double. We are looking at the CR, which is 2:1. If equal increase in current assets and current liabilities are there, that means we introduce, let's take it like 2 lakh is here and 1 lakh is here. We introduced 50,000 here, and the same amount is also introduced on the denominator side, because the question says current ratio is 2:1. Okay, and we are dealing with this specific area altogether. So what is it that we are doing? 2,50,000 is the total amount, and we divide it by 1,50,000, everyone. In this case, what's happening? It's 2,50,000 divided by 1,50,000, giving us 1.67:1. There's an increase in earlier we were 2:1 na, there's a decrease. This goes lesser, right? Then everyone, the answer is decrease in the current ratio. Now comes the next question. The cost of retained earnings is generally considered. The retained earnings is generally considered in terms of the retained earnings is actually lower than the cost of issuing new equity. Chaliye, let's end the session here itself. But before I end the session, let me show you our website where you can review our courses. Just go on to the area of www.adda247.com, everyone. If you go on to the website, you will find it. This entire area, you have got Just a moment. There it is. You need to go onto our website and check it out on our website itself, and you will find the JIB and CIB entire area. Go on to the area of JIB May 2024 and you will find the entire area in the Mahapack. Use the code Y541 and Y541 and apply it. So get it at 81% discount. Thank you so much everyone. Bye bye. You can actually check this out before I actually end the session. This is Mahapack. Mahapack is available at 12 month and it is available